Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. My guest today is Gary Lipsky of Break of Day Capital. They have a clear mission: help investors avoid the costly mistakes he encountered early in his journey. And that's what this podcast is about too. But Break of Day Capital prioritizes transparency, rigorous due diligence, and investor education in multifamily real estate. Let's go. This is episode 246 of Zen and the Art of Real Estate Investing with my guest, Gary Lipsky. Gary is the president of Break of Day Capital. He has 20 years of real estate entrepreneur experience focused on multifamily syndication now, well over 3,200 apartment units, over 280 million. It's always more whenever I do this. Gary, welcome to the show.
Jonathan, thanks for having me. Appreciate it.
Yeah, I always like talking syndications because, as I was saying in the pre-call, can do a lot of syndication shows, but everybody's view on them and why they got into them is different. So how did you get started? When was the first time that you remember real estate being of interest to you?
So, I wish my parents really talked about it, and they never did. But really, late 20s, early 30s, I was looking for my first house and I was in debt, didn't have any money down. And trying to find the right neighborhoods, and found like a fixer in Mar Vista in Los Angeles.
Yeah.
And that was my first foray. We converted the garage to an office, so I knew I can get $720 for rent to help with the mortgage.
I mean, that's pretty advanced though for a first timer. Did you even know what you were doing, or were you just thinking this is just a smart use of space to get money?
I spent a few years really understanding markets and whatnot. I mean, but at the end, there was no podcast really. Like I was just learning how I was going.
Yeah.
But it laid a seed. I didn't know that I was going to go to real estate at that time.
Yeah.
But I saw, I like the creative side. I like the number side. I like creating value. And I mean, this is over a long period of time, but like I started getting more and more into it and whatnot. And ultimately got into it full time when I sold the business at the end of 2016.
What was the light bulb moment? Was it part of this first property where you see like, hey, I'm up 200 grand? Like, this is pretty awesome.
Yeah, absolutely. I thought I was able to, navigate that. And then, I guess as my girls were starting to look at like middle school and figuring out like where we would send them and like, figuring out, do I want to invest in a house versus private school, and which neighborhoods, and buying, I lost a lot of value, after 2008, but me upgrading to a better neighborhood and a better house, that margin was much lower. So it was just all laying, seeds, for the future.
Yeah, what you described is the opposite of what people can do now. It's why people are sitting in their homes, because if they upgrade, not only do they have to pay way more, there's also limited inventory. So they're paying like X times 3 on it. But yeah, that makes a lot of sense. And I think that's why paying attention to the times, no matter what kind of level you're at in real estate, can still be beneficial. Maybe you sold at a value that could have been higher before, but then you bought in bigger at a lower value. So it's a win-win.
Yeah. And I was kind of weighing, I had a friend who had been in real estate for a while. He's like, you should sell and rent. And I'm like, I was looking at those numbers. I'm like, it still didn't make sense. Plus the pain it would be for my family, it just wasn't worth it. But yeah, I was doing all these reps, all these at-bats that helped me down the road,
Yeah, I love the term reps. I always use it. I think of Malcolm Gladwell's tipping point, and every time you're doing a rep, you're trying to get to those 10,000. But you're describing, I think, a lot of what people are going to face now, where we have a housing shortage, and this will play into potential syndications. And if people want to send their kids to private school, they may have to opt to rent because they're just not going to have a giant down payment, especially not, in California or Seattle and some of these areas that are just high priced. What do you think about that? And has that played a role in how you guys are thinking about multifamily syndications now?
Yeah, I mean, depending upon which source you look at, it says we're 3.8 to 7.2 million housing units short. Obviously, affordability is lower than ever. And so, yeah, there's so many people that need to rent. And we focus on Class B, typically, where they don't build new Class B, they'll build Class A because that's the only thing that pencils. So working in that area, it allows us to have the greatest amount of renters. And we could still have a nice, we bought recently 2 1999 products. So there's still some value add component, but it's a high quality property.
Yeah.
That isn't, we're not trying to get the best rents. It fits right into that middle band,
Yeah, I've been talking about this a lot. I love the point that everyone's building A's. It makes so much sense. But I think if you're new, you're not thinking of it that way. Or even if you're new to syndications, you might be thinking, oh, well, I want to get into an A. But B has a very distinct advantage from what you've said, meaning there's not really competition. The competition is all building higher. So you're really only in competition with the B's around you or the C's that are trying to get up to B, but they're always going to be behind.
Yeah, absolutely.
Yeah. How are you qualifying something as a B? I know it's almost like a you know it when you see it type of thing for each market, but for listeners, I've always tried to help them because the ABCD thing is so hard. D, you generally should know it when you see it, but B and C can almost look the same. It could be a geographical issue. So how are you coming up with what's B to you guys?
Yeah, and when we started, we were definitely doing more C's, more bigger lifts. But, I would say that one, the look of it, because I've seen properties that are 1999 that look 1979. And yeah. I'm like, yeah. I won't, or 1969. And I'm like, I won't buy it. There's nothing I can do to really make this look nicer. And I want to, whenever I look at a building, it's like all these different things that we can do to make it look nicer that don't cost a lot of money. Obviously, paint and landscaping, adding some amenities like a dog park, but a good tenant base. So I'm looking for median household income in the area, good shopping. I'm not necessarily looking for Nordstrom's, but a Costco or Walmart, just something, decent retail and commercial spaces that are filled up, not empty, parking lots.
Yeah, especially now. I mean, it's much more relevant to see what's vacant now. But you made a good point just talking about just randomly Costco and Walmart, because I think that people forget. And a lot of times when people are talking self-storage, they talk about it because they're diving so hard on data because there's no people involved other than the people who are going to pass by the storage. But in multifamily, it's really important because these companies spend billions of dollars on research to what's going to happen over the next 20 years. So I've always said, if you see a Trader Joe's, like lock up anything that you can because they've done the research. And now I've even found that companies like Sherwin-Williams and Benjamin Moore, Home Depot, like they're perfect for you. So that's an indicator in terms of what's coming for the next time, right?
Yeah, we often do like the Starbucks search too. Like how many Starbucks are in the radius,
Yeah.
And multifamily, you got to put eyes on it. Just because we have data points, when we only focus on a few markets, so we could be experts in those markets, but we'll always put eyes on the property and the surrounding neighborhood, just so because you just don't know. It might look great on paper, but when you go visit it, it's it could be some very bad properties in that area or whatnot, and your eyes give you the full story.
Yeah, I mean, and that's a great reminder to remote investors that somebody needs to really be your boots on the ground, especially if you're going into 100 units, because as you said, Google Maps, that's going to be 2 years outdated sometimes. I'll still spin around just to see what I can see, but you want to know what's across from the apartment complex, Is there a graveyard? That's going to be a problem for some people. You're just looking for anomalies that don't make what you see in the data as good in real life, right? And that will separate it.
Yep.
Yeah. It's interesting, though, to think that people can look on paper and something can look really good on paper. Of course, it could just be, fake numbers. But even if the numbers are real, there could be something in real life that you find that doesn't work. So how have you whittled down markets to just make sure, hey, these are our markets, we're going to stick with them? Is it a similar kind of demographic trend for this B type of property?
So being based in Los Angeles, we want to be close to some good markets. We're not going to and be there on a consistent basis. So even though there's some good stuff in the Southeast, it's just too far for us to be consistently. So we've done all of our deals in Arizona, coincidentally, where that's not the only place we're looking.
Yeah.
Mostly in Tucson. It's over 1 million people in the MSA, and people kind of forget about that market. So we've been really.
I was just about to say, it's like people just say Scottsdale and Phoenix as if Tucson doesn't exist, and it's huge. I mean, yeah.
And so when we bid on properties in Phoenix or Vegas, sometimes we're getting outbid, even in today's market, by millions of dollars, where that's not the case in Tucson. We're pretty close to where we feel we should be. And because we've bought so much, brokers will come to me first because they know I can close, and they know I'm a very active buyer if the price is right, if the criteria is right.
Yeah. And, for people who want to get into large scale multifamily, that is really the key. You have to be someone who's a closer. In residential, I still think you need to be a closer, but it's much more like, hey, this just looks fine, let's take it. But when you're talking large scale commercial, the worst thing for a broker who's a listing broker of commercial is to bring someone to the table for, a $16 million deal and then have the buyer just drop out because they didn't do good due diligence. So you've built up those relationships, and that's why you like to stick to these areas. Yeah,
100%. And then you asked me about my criteria earlier. So we want to be in a landlord-friendly state. Above average population growth, above average job growth, job diversity. And so Tucson and that Southwest are those types of markets. So that's what we like to be. We have tailwinds. So even if a market is underperforming, which I think we've all kind of faced in the last 18 months, we still have wind behind our backs, pushing us forward, not running into the wind where you have negative population growth and job growth. So that just really helps us minimize our downside risk.
Yeah. And I mean, Arizona is known as a pretty development friendly area, but is there as much going on in the A range in Tucson as there is in the other areas? Or do buying the B in Tucson really help you because there's just not as many new builds going up?
That's what I love about Tucson.
Yeah.
I think in the last year, like 2,400 units were delivered, which is, in Phoenix, you're talking about 40,000. Yeah.
Someone thinks in their head, 2,400, that's a lot. It's not. Tucson's huge. That's like nothing. It's like, 7 complexes or something.
Yeah. Yeah. So they really don't build much there. So that's been really helpful as well.
Well, that kind of gives you, your B becomes a B plus in the area automatically, just because what it takes to get to those A, the price differential is a lot of times going to be too much for the tenants. And one advantage that you talked about before is, as a very strong B operation, you can really have very good price points because there's a big jump to get to the high A's, and there's not like a ton of A minus type of things out there.
Yeah, absolutely. Where, we're seeing like a 25, 30% discount right now in pricing. So we feel like it's a tremendous opportunity to gobble up these kind of B plus, A minus properties.
Yeah, it makes sense. So is Tucson the main market that you guys are focused on?
Yeah, we've done almost all of our deals there. Again, not where, we bid in other areas, but at the end of the day, when we look at the price point and our underwriting, like that makes the most sense for us. But we would still like to have a little bit more diversification.
Yeah, but I think it says a lot that you've made offers out and other places lost, but didn't, force the square peg into the round hole. Because I think if you just look across the syndication space over the last years, there's a couple people, maybe it wasn't geographic, but there's plenty of syndicators who, they made that large reach at the wrong time and now they're in trouble. So how do you make sure that you don't get that kind of adult FOMO and just like, really, everyone says the Southeast is crushing it, but we're so far away. A lot of people will do it.
Yeah, I mean, it's staying true to, our criteria and what we believe. And it just shows for my whole team. I've got 5 other people that work for me, and they all invest in our deals. And, they when we do DD, everyone goes.
Oh, that's awesome.
So they really know what, when investors are calling, that they can all speak to it, and they believe in the product. And so we're all galvanized to take down a deal. And we just lost one a couple of days ago that we were all like really excited about, and everyone was like a collective, like so disappointed. But literally like an hour later, a broker that I've done 4 deals with called me, and he's got one that just over the phone, I could tell like it's right down our alley. We haven't fully underwritten yet, but it's just something that we'll, probably aggressively go after because it clicks the boxes so far on what we look at.
Yeah, I like that the whole team goes to see it because, as you said, then just if they're talking about it, they get a random contact. They're not as detached from it. A team of 50, of course, everyone's not going to be there. But if you're on the phone talking investments, or if you're just someone who, wants to put an accredited investor in, it's very hard to get across. Oh, well, what's across the street? I don't know. What are the demographics like? I'm not sure. Let me set you up on a call. But if you have to take the time to do that, you might lose the person in the middle. Yeah. And so in terms of your avatar for investors, for you guys at Break of Day, what types of investors are you looking for? Because we talk a lot about people understanding that investing in syndications is generally illiquid compared to a lot of other things. But is there a certain type of person that you're looking for in the way that you guys do syndications?
Yeah. I mean, we haven't completely narrowed it down. We just say the busy professional that doesn't want to do it on their own, because I think there's a lot of push, like bigger pockets or whatnot, to like do these single families on your own. And it's a lot of work. It's a job. And you realize the margins are so small. It's not worth your time. Invest with a team of experts that do this full time. And you obviously have to do your own due diligence. Just because they have a team of experts doesn't mean, their underwriting is good. They're not chasing fees and whatnot. So you really got to know the underwriter. The operator first, and then really dive into the deal. But to me, I think that's the best way to be investing. And that's our avatar, that busy professional that wants someone to do it for them that they know, like, and trust.
Yeah, and then I think that's the way you just build up a referral base, whereas a syndication company, you don't have to be out there chasing deals. There's enough in the pot where most people are just going to re-up if they've done well on an exit. There's no reason not to just keep the snowball rolling most of the time unless they, need the money. But have you had to have those discussions with people like, hey, this is different from you, especially for first-time people who are accredited, high earners, but they have to understand, you're not going to have any input. You can't get the money back until we go full cycle. This is just how it works. I find that as someone who's new to investing in syndications himself, even after all these years, I had to have those discussions in the beginning, almost with myself, like, hey, I have to be okay with this. And for me, I actually prefer the illiquidity of it because it just saves me from myself trying to like do another flip, as you were saying, which is just not a great use of my time. If I want to do that, I want to do it because I'm choosing to do it actively, but not as this same amount of return that I want to get without doing any work.
Yeah, obviously we want to see if they're accredited, and then 2, have they done a syndication before, so they understand it. And if they haven't done it, then we really spend the time to really go through the process. So, and thankfully, we've done a good job because none of our investors have given us a hard time, where I've known other people that are like co-GPs or other syndicators where they're overselling and they're just getting people in, and they have a lot of problem with their investors because they didn't communicate these things and educate them.
But what was it like on the first one that you syndicated? Because that has to be a little bit scary because everybody's new at that point, other than, people who work there and friends and family. But there's a fair amount of like, hey, we all just hopped aboard the ship. Let's make sure it doesn't sink. And I wonder if these people are going to, after a month, if we delay a distribution 4 seconds, are they going to be calling?
So I was confident in my abilities as an entrepreneur because I've been running businesses even since I was like in high school and college. But obviously, I've never owned an apartment building before. So we bought a building for $1.65 billion. We raised $1 million between the 3 of us. I only raised 100, and I was awful at it because I haven't done it before. Yeah. And I just wasn't I wasn't comfortable yet.
Yeah.
But luckily, I had 3 people that came in at $35,000 each, roughly, and just took a chance on me. They knew, what I had done previously. And so the next time was a little bit easier and a little bit easier and a little bit easier. And then you finally figure out, hey, I'm really doing good work here. I believe in what I'm doing. All I'm doing is sharing an opportunity. And if they want in, that's great. And, I had friends that some jumped in right away. Some waited to my 5th deal or my 10th deal.
Yeah.
And I gave everyone the whatever time they needed. It's like, when you're interested, let me know. But this is what I'm doing. And if you have questions, I'll happily answer them, walk you through it so you're comfortable. And if you're ready and when you're ready, great. If not, then so be it. I've got some friends that have never invested in it and they know what I do. I don't bring it up. I don't, like if they're interested, they'll ask me, great. And if not, it has no effect on our friendship,
But that's a big and very important psychological shift from the beginning to go to like, hey, this is what I'm doing. That's all. I'm not really going to chase anybody for it. I think that kind of releases the pressure of asking someone for money in general. And you use the word that I always use as well. Hey, look, I'm just presenting you with an opportunity. If you don't want it, it's no problem. And I think it feels better in your mind when you're trying to ask someone for money to not say, hey, can you input? I really need something from you to get there. It's like, hey, here's a cool opportunity. Other people are in it. You can too. Do you think that really helped? Because it probably felt a lot better on the second and then the third when you change the mindset.
Absolutely. Well, as I got comfortable with it, and I mean, this is serious business, and taking even $25,000 from someone, I don't care if they have many millions. I mean, that's a huge responsibility, and I think in the last few years, a lot of people abuse that process and that right because they didn't understand the deal. They're just raising money. Oh, this is easy. This is real business stuff, and there's ups and downs. And whether it's someone a good friend of mine or someone I don't know, I am taking a good chunk of money, hard-earned money, and I better, have tremendous fiduciary responsibility, transparency, and responsibility because of that.
Yeah. And I mean, obviously, a lot of syndicators kind of really didn't do a great job, and there were too many new ones in the game. And some really just got hit by random metrics of floating debt and things like that. But on the defense of several syndicators and forums that I read, a lot of people who weren't well versed going in are trying to blame stuff on the syndicators when all the information was there. You just bet on a horse that didn't perform well and no one really did anything wrong. And they're trying to make it like, every syndicator who is in trouble didn't really do a terrible job. Like some things just, were happenstance. Do you agree with that?
Yeah, absolutely. At the end of the day, everyone involved has to take responsibility. We're all adults. And so, I've got some deals I put too much leverage on, and I've got to take responsibility for that, and so on and so forth for people that maybe raised capital or got deals that weren't performing. I mean, at least our deals, we had very conservative projections, and so we're beating our projections for the most part. And so at least it gave us a much better chance for survival. But the ones that were super aggressive and high leverage and the floating debt are hurting.
Yeah. I think the transparency is the important part. If you're transparent going in, like we're using this type of debt for a reason, it's a little bit more risky than the norm, especially now people know why it can be more risky. Then at least you feel like, listen, everybody was full knowledge. They may not have been listening, but that's not really your fault, as the operator, if you've given them all the information. And I just have found that there's a lot of user error in the game, because there's inherent risk in any investment. So when we make it, whether it be stocks or, startups or something, we have to know we could lose it all. We're hoping not. But I think everyone likes to take, it's not my fault. I gave it to somebody else, but we're making decisions together in those things. And that's where that initial dialogue when you're taking in investors is really important too, because you're saving yourself later, from people who are going to be a problem and just waste your time.
Yeah. And I think the investor also has to take some responsibility too. They know going in, they're reading the PPM docs. I don't want anyone to lose money. I want everyone to, prosper and thrive, but we're all adults and we all know we all have choices. And so we have to be held responsible for those choices.
Hey, I hope you're enjoying this episode with Gary Lipsky. If you're interested in getting involved with what Gary does at Break of Day Capital, you can wait till the end, you can take a break, but you can go to breakofdaycapital.com, click the button that says Get Started, and you're on your way. Let's get back to Gary. Yeah, so for you guys at Break of Day, why multifamily? Have you ever been interested in any other types of large-scale assets?
I like what we do, and it for me, it's not that it's simple, but it's already built, so you're taking out a lot of risk. It makes sense. Everyone needs a roof over their head. There's a tremendous shortage. We've just tried to stay focused, and I know in the last few years, a lot of people have kind of dabbled in a lot of different things. I really like to hunker down, focus on it. I mean, we'll look at some different things just to educate ourselves to say, hey, is this the best investment? Should we be looking at self-storage or triple net or whatnot? We feel very comfortable in this space and are we feel very good about the future in this space. So that's where we've operated in. Down the road, maybe we'll, focus on something else. I don't know. But one thing I want to be sure of is like we're not dabbling in a lot of different things, in a lot of different markets. We really want to be good at what we do. So, anytime we're looking at a new market, we're going to get thousands of data points so we can make more informed decisions.
Yeah, and each time you break a new market, you're still a new person in that market, but you can say, hey, we have, 13 full cycle in Tucson or something. That definitely helps, but still you have to adapt to new regulations. So when you're going from market to market, because I've talked to a lot of people, whether it be multifamily or something else, are you looking for other markets that behave similar to, say, Tucson? Because that's where all the most, like, you want someone where the landlord tenant situation is generally the same, demographics are similar. So you're not like reinventing the wheel on a city. Correct.
Yeah. Not trying to learn all the new laws and whatnot. So we really stay on top of it. And also being in that concentric circle where we can visit these properties, these markets on a consistent basis, develop those important broker relationships. So we're not gonna be chasing things all over the place.
Yeah. So when going back to your beginnings, did you start investing in other assets, obviously, before you started syndicating? What type of things were you investing in that really led to your, eventually getting to syndications? Because you did touch on a thing that, of course, probably may have come up for you. We'll find out in a second. But there are a lot of people who they accumulate assets and then they realize, well, why do I have all these doors? They're producing a minimal amount, together. Why don't I just get one big asset with all the doors in one thing?
Yeah, I had one rental for 2 years, and I wanted to get that tax relief of like, if you live in it for 2 years out of the last 5, you get that 500,000. So I utilized that and stocks and stuff like that. But I felt like that was so easily manipulated. I didn't have any control, and I've made mistakes, and I'm like everyone in the stock market, and I just wanted to have control, and so. My diversity right now is actually, very bad. I've got so much, almost all my money in Tucson right now.
Yeah.
Over time, I'll diversify it more. I have very little bit in Bitcoin, some other things, but for the most part, it's like liquidity for my loans and like my assets. I'd bet on myself any day over anyone else,
Yeah. Well, it's also like the iron's hot. So you stay in the area and then you figure out like when the time to diversify is. But if people keep presenting you with deals that pencil because you've closed X amount of deal, you can't just start saying no to good deals when you know how to operate in the area. And that's hard because, you just say like, okay, maybe we do want to be geographically a little bit more diversified, but everybody knows you there, so you're going to get the best opportunity to get deals there instead of, Vegas where, even if you have connections, there's other people who've done more deals. So you're still kind of, climbing the ladder there to get to that VIP section where you get the call first instead of second or third.
Right. And we've leveraged like the brokers in our areas that have the, their same company is in that, like Vegas or whatnot. But yeah, absolutely,
Yeah, I mean, it helps being close by geographically, like you said, to just focus on some type of, triangulation of where your geography will take you so you can get there if you need to. Yeah, I've owned out of state assets, and I find I don't think about them enough. I just find like it's and again, if it's only a one-off, especially on the large scale, you get 200 units in Missouri or something, it's just a harder management. You're going to pay more. You haven't vetted them. You're building all something new. So I think it makes sense, and that's how people have to see as syndications. Though, if they come to you and they say, so when you go to say you do get one in Vegas, you're still able to say like, well, hey, we're still really using all the same players because we're geographically adjacent, right?
Yeah, our property management company was bought out by another company, and they're all over the place. So yeah, we can leverage them. And yeah, we can go to Vegas and then fly to Tucson. When we go to Tucson, there's no excuse not to be there on a consistent basis. And half the time we don't even tell them we're coming, but we can visit all of our properties in a day and have dinner with a broker, if we want to, and be home that night if need be. We're not in a rush, but there's no excuse for us not to be there on a very consistent basis.
Yeah, was California ever an option, or does the price point on these cap rates of 2.8, where it's like, oh, that was great, they just doesn't make any sense for you guys?
I've built some spec homes here, but I've never, besides that one single family, I've never really wanted to be a landlord here because of the laws and whatnot. I have friends that do very well, but I like the economies of scale. So, we're buying 150 units at a time. And so we can have really good staff. It makes my life much easier. It's the same amount of work, a 20 unit or 120 unit. And so it's just that's economies of scale. My expense ratio is lower. There's just more profit to be had for my investors and myself.
Yeah, I think people would think like, hey, well, 20 units in California, maybe those will go up in value more. But when one person moves out, then you have one vacancy out of 20 as opposed to one out of 120. So your management is much sleeker, and you really can create a better thing. I mean, California real estate, I've been a California landlord for a long time. My sister and I own multiple properties around there. And yeah, it wasn't as easy as I had hoped, but we were coming from New York, so everything seemed pretty easy. So as you go along, I mean, what's the next step for you? Are you really hoping that you can lock up a new market? And if so, which would be the first market? Is it Vegas that you're really interested in? Because that's where you've been bidding and just not, the other people are bidding higher.
So Salt Lake City is a market that we've been looking at more so of late. Still lower cap rates, but we feel like there's a tremendous opportunity in that market as well. So we've looked at a couple things. We've made an offer on a couple of properties. Haven't reeled one in yet, but these are all good data points for us, so that when a good opportunity comes about, then we know, we save all that information and we look at our spreadsheets and say, okay, well, this is what we bid on this property. It was this vintage, and these were the demographics and the median household income, so we can kind of figure out where we should be and where we would be comfortable putting an offer in. So it takes time, like you said, 10,000 hours on anything. So we've got that syndication down, but like new markets too, is just spending time in that market and really understanding it.
Yeah, before you got into real estate syndications, though, you were an entrepreneur in other fields as well, right? Do you think that helped you as you launched into real estate? Because I found that people who have the entrepreneurial spirit can understand how to get to the syndication part of real estate. They can invest also, but still that becomes a very wild business, as we were saying. Syndication's pretty tight line once you get it in. It's very, due diligence on this aspect, sending it out here, creating everything. It's pretty transparent if you do it the right way. Did you think that your prior expertise really helped you transition to that part of real estate?
100%, because learning how to manage people, learning how to work with others, and creating win-win scenarios, 100% helped. In my last business, we ran after-school programs, outdoor ed, leadership development, and we had 700 employees and probably another 700 independent contractors. So when people ask me about, do I want to be vertically integrated and own a property management company, I'm like, heck no. Like, it's just an HR nightmare. I'd rather focus on our strengths and leverage someone else's expertise and then manage them up. Maybe they're a 7 out of 10 and I can get them to an 8 or a 9 based on focusing on some of their weaknesses. And I don't have to have all that overhead and a whole nother business to manage. So it's definitely helped me a lot. And, we try to create win-win scenarios for our residents and for our investors. We want to improve communities. We want to do good as well. So that's really important to us. It's not just bottom line. We can achieve the same results by doing good in communities.
Yeah, and I mean, based on what you were saying, it must actually, the thing that people forget about multifamily is they look at it as a strict investment sometimes from the outside. I know all major landlords, are slumlords, are just trying to get the building rent up of people. But doing that B type of atmosphere can really help people. They can stay in good school districts. When you upgrade the facade or you upgrade the management, it's a huge benefit for the tenants who live there, because you go from a non-responsive management team to one that's responsive and one that's going to clean everything up, maybe get out the riffraff that's not paying or is causing problems, which is usually a very small percentage, in B, but they're always there. So you can really have an impact. And I think people forget about that. Have you been able to see that now? Like when you go back to ones that are still active before they go full cycle and like, wow, this is really better for the residents also.
100%. We've drastically improved the communities. We're doing community events for our residents, so they have those connections. We've added amenities, so they feel really proud of where they live, and we feel really proud to provide that service. And that's why our residents stay longer at our properties, even if we've increased the rents, because they feel like they're getting a lot more value for at our communities than another community.
Yeah, I think that if you're an active when you're in the transition stage and you're transparent and people can see the upgrades and amenities coming in, the upping the rent is not a problem. Anyone who's against it, either is, they're punching outside of their zone a little bit, or they're just being stubborn, because if it's $20 a month or $30 or even $50, if you're getting all of these new things in and you're getting, like we were saying, new management who's actually going to respond right away, to a service call, it can change the entire way that people feel. And then if everyone feels good, 180, say, residents feels better about it, then it's a safer place. Any community, whether it be A, B, C, or D, if the management team is terrible, nobody's happy. So they're always angry about everything, which leads them, more calls about, oh, my neighbor's being loud upstairs and all of that stuff that you don't want to hear. That's why you have a property management team. Yeah, I think that it's just this one thing that people forget. The news focuses on the data, but they forget about how much you can change. Are there any amenities that when you go in to buy a larger scale building that you're like, hey, we need to get these in here right now, 2025? These are the amenities for apartment complexes that I think are more important than they used to be.
Well, obviously, the land is important. Like what kind of space you have. So, but dog park is definitely one. It's inexpensive with the toys and the fencing. You're talking maybe $15,000, but probably half the residents have a dog, whether it's a service dog or they're actually going to pay pet rent. That's another story, but that's a good amenity.
lots of fake service animals, those emotional support ones out there.
Yeah. Then we like seating areas where people can get together. So like a pergola, maybe a barbecue area if they don't have it. And if they have those cheap ones, and we like to, have a nice, barbecue area so that people can have cookouts and invite their friends, or we have events there as well. The pool area typically needs to be upgraded, more seating, maybe some shade, playground area. So basic stuff. Like I know like Class A, they'll have like dog washing areas and stuff like that. Like we don't go crazy. We'll update the gym, stuff that doesn't cost a lot, but it goes a long way. We had one property we bought in December 2023. We had some extra land, and our property manager's like, I want to create like a community garden, and it didn't cost much, but we built that because tested it out, didn't cost much. And even if we had 5 residents that appreciate it, then, that's fantastic,
Yeah. Well, that can be something that generates more community, and people are like, oh, at first I wouldn't have liked it, but now, why not? It's right there. It's funny though, you said shade and I'm like, wait, we're talking about Arizona. How could there be no shade on a pool in Arizona? It's like, everyone always asks me, hey, what was it like? Did you like the weather when you went to Arizona? And I said, yeah, I love sticking my head in an oven. It feels great. That's that's dead summer. I hope it's all shade there at the pool, because the pool's probably hot just sitting in there as it is.
And don't think any of the pools have shade, but then we do the pergolas and whatnot, and like over the picnic tables and stuff like that. So we'll have shade there. But yeah, it's no fun. 115 degrees walking units during the summer.
Yeah. So, I mean, over your years in the real estate syndication field for multifamily, what do you think the most important thing for someone who wants to get into it is to know? Someone who's out there, again, they have disposable income, they're accredited, they are a little bit busy, but they're willing to do the due diligence. I think that's always an important point. What's the most important thing that they should know about syndications when the news has not been so friendly to them for good reason for a lot of ways?
And you're focusing on an investor, correct? Not an operator?
Yeah.
Okay.
Investor.
So first off, they should buy my book, Invest Smart, Spotting Red Flags in Real Estate Syndications.
There you go. Good plug too.
Right. But really get to know the operator. You're betting on the jockey first. That's the most important thing. What's their communication style? Do they get back to you right away, or is it takes a long time? And if you invest with them, it's not going to get better.
Yeah.
What's their track record? Have they done a number of deals in this market? Have they been successful? If they talk about their track record as being perfect, you don't want to invest with them, because they either, one, haven't done enough net deals, or they're lying. Because like any business, it's impossible to bet 1,000%. There's going to be some ups and downs, and you want someone to be transparent and be able to talk about it. I would suggest I'm investing with someone that does it full time and has a team of people that support that person, because if they're just dabbling in it, or if they're chasing all these different assets, it's really hard to be good. Now, if they have a huge team and they've been doing it for many, many years, then I can understand having multiple markets and multiple asset classes. But having a focus is really important. And I would also, once you start looking at the deal, how is the money returned? Is it 100% of the money back to investors first?
Yeah.
Is there super high fees where the operator is getting all this money up front? And so, as an investor, you're really not protected. And so it's really important to make sure, like for our investors, they get a pref, they get 100% of their money back first, then we go into the split. So if we perform well, then we all share in the profits. And if we don't, then investors are protected, most importantly, first.
Yeah. And I mean, that should be in the due diligence document so people don't have to ask. So if you do have to ask, you're probably already a little bit behind the curve, unless it was like, oh, yeah, actually, we forgot that. Let's update that. Because if you're a well-seasoned syndicator, you know what everyone's going to ask. So you want to lay it all out there, because then you have just less phone calls from people that aren't the good kind of phone calls. They're just kind of minutia phone calls. Hey, what's this? What's, the footnote 7. But it's a lot of due diligence I found when I first started investing in. Like when I got the PDF, I'm not going to read the whole thing. I'm just being honest. Like no one's going to read the whole thing, but you need to know where to look and understand which things are really important to you. And don't you think it's also important for those people who are trying to get into it? They have to know what their risk tolerance is, because everything has, as we were saying before, it has some type of inherent risk. And you have to know, is this a risk I'm willing to take? And I'm willing to take the risk on the jockey, like you said. Am I willing to go with them on this journey?
Yeah, I think people get enamored by projected returns or bonus depreciation. And the most important thing is the deal. Don't chase a high IRR and get enamored by it, because it's just a number that someone can manipulate. Focus on a strong team, a strong operator. That's the most important part. And like you said, do your own due diligence. Just because a friend recommends a company or a deal, I've made that mistake myself. And because you don't know how much due diligence your friend made. Maybe they got lucky. So do your own due diligence.
Yeah. And as you were saying before, if someone's hit a home run on every one, guess what? The next one's likely to be the one that's, a very soft single. So you always watch out for that. Or at least somebody who's willing to acknowledge, like, hey, they're not all great. We've done well on everyone, but this is the worst one. And this is why. I think that's helpful. Again, more transparency in real estate across the board would just help everybody.
Yeah, absolutely.
Yeah. Awesome. Well, Gary, it's been a pleasure. Give us the name of your book again.
Yeah, Invest Smart. And if you email info@breakofdaycapital.com and mention this podcast, we'll send out a free copy to the first 10 people that email us.
Awesome. So remember that. Send the email, get the book. And do you have a podcast as well?
Yeah, it's called the Real Estate Investor Podcast, and you can get it across all the different platforms.
It's fun, right? I was telling you in the pre-call, like it's for like real estate investors who've been in it for a while. It's just an hour of just talking about real estate. It's always fun. And I find like listeners can just get so many random tidbits that you just don't know that you would get. I mean, I wish I had this as a kid, but I had a dad talking to me 24 hours a day about real estate. I didn't need a podcast because that's all he talked about was money, real estate, and how to do deals. But now we can just kind of broadcast this and people can learn a lot again. But as we were saying, you still want to get in there, do your due diligence yourself, know other real estate investors. And I think that helps you, balance all the information that we're putting out on podcasts.
Yeah. And I've learned on all my podcasts, I've learned something new each time. So
same.
Yeah, it's just a great way to learn and, converse. So absolutely.
Yeah. Awesome. Well, glad we got to spend the time and look forward to staying in touch.
Yeah. Thank you, Jonathan. Appreciate it.
Yeah. All right. That was Gary Lipsky. He's the president of Break of Day Capital. You can find them at breakofdaycapital.com. And if you email the info and you're in the first 10, you will get Gary's book. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 247 of Zen and the Art of Real Estate Investing. And it's Niyi Adewole, investor, agent, and cool guy. We go all through his journey, how he goes and does both like I do as an agent and an investor, what he learned as an investor, and which one came first, the chicken or the egg, or the investor or the agent. We'll see you next episode with Niyi.